On today's episode of The Rise, we sit down with Turner Novak, founder and general partner at Banana Capital. Turner took a big bet on me and was the very first guest for The Rise. I was nervous, awkward, and tried way too hard to sound like a real host. Through all of that, he somehow made it fun. He's built one of the biggest personal brands in venture, with hundreds of thousands of founders and investors following his work across socials and tuning into The Peel, his podcast where he sat down with guests like Sanjeet at Samsara, Ryan from Product Hunt, and Logan at Redpoint, among others. His portfolio includes BeReal, ScienceIO, B, and Chainguard, and today we cover how he built that audience from scratch, his advice for VCs looking to build a following online, and what he's learned raising institutional capital for Banana. Hope you enjoy. All right, Turner, thank you for hanging out with me in San Francisco.
Yeah, thanks for having me. Thanks for the coffee.
We've been putting out graphics highlighting different universes within venture. One of those that we're putting out in the next couple of weeks captures the emerging managers with the biggest social media followings. So when did you start posting on social? When did you think that it could turn into something meaningful from a pure sourcing, finding founders? Did you start when you were already in venture capital, or how did that all come to light?
Yeah, I mean, I think the biggest thing is it wasn't this like well thought out thing. The creator economy wasn't really a word. You had to be in San Francisco and you had to go to Stanford and work at Uber in order to be a VC, or maybe do investment banking. So that was kind of the world when I started doing it. And it was really just trying to get a job. I just realized a lot of VCs hung out on Twitter. And I thought, I don't know, I probably have interesting things to say. And if I just say things I think maybe directionally are going to be correct in a couple of years, but maybe are a little bit more novel now, and I just put them on the internet and have them, stand the test of time, it'll help me just kind of building a track record. So that was kind of the thinking. I used to tweet a lot of serious stuff. I'm sure everyone's kind of gone through that, where you spend 12 hours on this piece of content and then you
what do you mean by serious? Give me an example of that serious stuff.
Yeah, so I used to tweet the first thing I really started tweeting about was back when Snapchat did its big redesign. Do you remember this?
I don't.
It was 2017, 2018. I think basically they redesigned the app. There's tons of backlash. I think it got to a 1-star review in the App Store. Millions of people signed a petition saying bring back the old Snapchat. It was actually pretty insane.
That is
kids fucking hated it. It was sort of maybe you might remember when Facebook launched the news feed and everyone protested the news feed. And there was groups. Remember when people would join groups on Facebook as
totally.
A form of self-expression?
Yep.
I think my favorite was back in high school. I joined a group I wish my lawn was asexual so it would cut itself, or something like that. And maybe that was the name of the group. I don't know if I'm getting I don't know if that's hitting correctly, but so that was the type of thing that was going on. And Kylie Jenner came out and tweeted, and she was like, does anyone use Snapchat anymore? And the stock was down 20% in a day. I think it got to a point, the company was valued at $5 billion or something like that. And I thought it was kind of ridiculous. Every kid in the country uses this thing all day, every day.
Totally.
It's kind of today, people talking about ChatGPT, OpenAI is a house of cards, is overvalued. I'm dude, it's the only AI product that everyone uses.
Totally.
You could say it's fairly valued. You can maybe say it's under or overvalued, whatever. But that it's going bankrupt. That's the most ridiculous thing I've ever heard. It's the only AI product that's actually it is AI.
Everything.
So yeah, I just kind of started tweeting about stuff like that. I think I'd lay my thesis out of how these things would work. And I don't know, there'd be some cases you get 100 likes. And this was maybe a little bit more impressive back 7-8 years ago.
Totally.
They didn't even show views, but they'd maybe get 50,000 views or something, 100,000 views. And I just kind of put that out there. I kind of laid my thesis. The thesis is basically, it has about, at the time, it was pretty comparable reach to Instagram in the US. But it was being valued at 1/10 per user. And, I don't think Snapchat's ad targeting and ad product is anywhere near the same as Facebook, but it shouldn't be worth 10%. It should maybe be worth 50% of Instagram or something. And Instagram at the time was valued at 100 billion or something.
Wow.
Analysts pegged it at. It's probably worth $1 trillion now or something. Like, it's extremely valuable. And I just kind of put it out there that, you know, I don't know, Snapchat could be worth like 100 billion kind of a thing. You know, here's how they can get to like 10 billion in revenue. I think they're actually pretty close now. But at the time, it was like a little bit ridiculous. Company valued at 5 billion that you think will get to 10 billion in revenue. Like, it's just kind of a ridiculous thing to say. The other thing that I did was I tweeted a lot about TikTok back when it launched. I just was like, no, this is the best product I've ever used. You know, it's kind of insane when you compare like how the TikTok product works and then how the rest of kind of social media has evolved over time. Like, basically everyone has borrowed from the concepts that TikTok introduced, like full screen video, making videos shoppable and you can take actions on them. So I just kind of like laid that thesis out. And there's another thing where, you know, in August of 2018 when it launched, it'd be like saying when somebody launches some silly AI app, like, this is the next ChatGPT, you'd probably be like, I don't know about this. So I just kind of tried to pick things like that and put them out there just because I knew I was like pretty confident that in 2 to 10 years I would be right. And then that's kind of the, you know, how you build a brand really in some cases, especially in being more like intellectually, right?
Totally.
Like, you're trying to like show how smart you are in a way. And then probably one of the biggest breakthroughs that I kind of had was I just had a friend who started a meme account and he's, you know, was making memes about venture and startups and like, and yeah, I started helping him with tweets, coming up with ideas and he like slapped, they'd get like thousands of likes and it'd be like, you know, the founder of a public company retweeted it. And I'd be like, what the heck? This is crazy. Like, why do founders resonate so much with this content? And it's because a lot of VCs just don't make good content. They treat it as a second class citizen. It's almost a check the box.
Yeah.
They take someone who worked in a product marketing role at a B2B SaaS company that's like 26 years old. And they're just like, make some tweets, write some blog posts, go on LinkedIn, start us a podcast. You know, we need to get in some press articles. And it's just like kind of one person that does sort of all these things. And like, they're not really that good at any of them. And it's like an employee doing it. They're like trying to get the GPs to buy in. So then you get this weird like kind of dysfunction where it'd be like 3 days after something happens and someone like a VC writes about it. And you're like, we've moved on. Or like, why are you talking about this? This is like a weird thing that you're spending time on and putting it out there, whether it's them, whether it's a ghostwriter, their marketing person. And then a lot of the times they're just like, I don't need to do content. Like, this is dumb. So they like phone it in. So I just kind of had this realization that just like a lot of venture people just didn't do content that well. Yeah. And so I just kind of kept leaning into it. I leaned into doing content well myself, but also this kind of meme thing. It was kind of this like supply demand of content where I think just generally on the internet, you want to find things where there's low supply of content and high demand for it. And I just kind of realized that people wanted humor. Like, nobody wants to know, you know, doing this breakdown of like how MCP in AI is going to like evolve. Like, everyone's read that stuff. Every venture fund puts out a blog post about it. Every AI startup is writing about it. Yeah. But if you like make a joke about how there's more blog posts about MCP than there are actually like MCP use cases or something like that, I don't even know if that's funny, but yeah. But everyone kind of gets that and totally. They're like, oh, like, and they share it in the group chat. So I thought a lot about that kind of stuff. Is just like it's just kind of how you stand out. I think a lot of optimizing for the group chat is something a lot of people don't think about. Nobody makes a purchasing decision based on something shared in a group chat, but no one's sharing your B2B checklists that you're posting on LinkedIn in the group chat either. Yeah. So you kind of need both. You kind of think about marketing as like top of funnel, and then the bottom of the funnel is, you know, you hang out with someone in person and they're like, oh, this guy's pretty cool. Like, you should invest in my company, or I should invest in this fund, or whatever the spectrum of that is.
I feel like at least once a day, sometimes you get me a few times, I definitely laugh out loud at least one of your tweets. Are these all written by you? Have you ever used a ghostwriter? And do you, I think, follow on to that? I mentioned the ghostwriter like joking in this context because I know it's you, but I think it's you. But I've probably had more requests this year if I know any ghostwriters for very respectable GPs, emerging and fully emerged, that are interested in that. So I'm curious Is it all up? Like, are you writing all of this content, or do you plug in and like dial in on a Sunday for like 4 hours and just like knock out like 100 X posts that you have like queued up for the week, or is it all just on the fly? Kind of comes into the head. How does that all work?
It's 100% just make it up as I go.
I love it.
That's why there's like typos sometimes too, right? Like, I think it's kind of the joke, the meme is like, you'll spend an hour, something super witty, craftful, insightful, and it just flops. And then you'll have one where you're like, you literally typed it up on your phone in 3 seconds, and you like didn't catch that there was a spelling error, and you just send it, and like that gets 1 million views. I've definitely had that before. So yeah, I mean, it's just me. I think that if you want something to kind of be your core competency, you don't outsource it. And that's kind of what I chose to just be the core competency, just like understanding how the internet works, media, content, online. It's kind of the place I can come in and help founders with things. I think some people would argue that distribution is actually the hardest problem right now. It's pretty easy to build a product. I'm exaggerating that a little bit, but like, it's easy to build a product. It's hard to get people to use it. And so that's kind of the value prop, is like, for a couple percentage of your company, I can help you with that. For some people, it's not a good deal. For some people, that is a good deal. Of course, there's more that you do. Every VC adds value with like in all these different magical ways. But that's kind of probably the way that I differentiate in a way. And people probably already kind of know and trust you. Like, they kind of see that you're out there. Yeah. And they kind of know what you're about. You kind of think of the contrast of like what the firm kind of stands for. There's probably like certain types of founders that resonate more with what I'm doing. And then there's some that resonate more with like someone like what Susa's doing, or, A16Z, like they all kind of have their archetypes that they go after. So yeah. And then in terms of the only thing I really plan out and queue up is probably the podcast. I record episodes a couple weeks ahead of time. Usually post like 1 or 2 clips a day from the podcast. And I usually do those ahead of time. I just found you got to like open up your editing software, load the clip, open up what you kind of had called out as something you might want to clip. And like, it's so much more efficient to just, when I'm editing them initially and kind of looking at it, I just go to tell my editor, like, here's 10 timestamps, just grab these. And then I have them, and then I'll just post them throughout the week. So
I love it.
So I do not edit my own podcast in the sense of like all the audio production and the tactical nuanced cuts and stuff. I have an editor that I work with, but I do watch them all, spend a bunch of time on it. It was kind of like a pretty strategic decision a couple of years ago. I just kind of saw that video was an important thing. I think writing you can outsource. Like, writing is pretty easy. Just have a ghostwriter. No one knows. You can just say it's you. I think it's a little bit disingenuous, but everyone does it at the end of the day. Like, all content is ghost. Like, the CEO of McDonald's is not making the ads, right? Like, you eventually get to a point where like you are completely outsourced, and like no one on the marketing team at McDonald's is in the McDonald's ads.
Totally.
Right. So you do hit a point where you are removed. But I think the interesting thing about just the internet with like personalities and media is that you do need to be the one who's like the face of it. And I just think putting yourself in front of a camera, being on video, or maybe it's your voice, like, you can't outsource that as a GP. And most people just will choose not to do it. Just because it's different, uncomfortable, they don't have time, they're not good at it, too expensive, like whatever the thing is. So I just made decisions like, I'm just going to do it and figure it out. So I think a lot about like just what can you do that's just actually defensible longer term and harder to outsource. So
I looked through your portfolio before this. 3 acquisitions. It looked like BeReal, and what was the third one?
ScienceIO.
ScienceIO.
There's a couple other companies that have been acquired, but I didn't make as much money on those. Like, they returned like half the capital. Like, they got acquired by a public company, and it maybe sounds good, but it's just like you invested $250K and like you got $100K back, kind of a thing, right? Everyone has a lot of those.
Totally.
So,
but I feel like most folks talk about early venture like that 7 to 10 year window, right? So I think it's a really good signal that you're getting these outcomes pretty, like, within your first 7 years of Banana Cap. I think that's pretty awesome.
I mean, they're all single digit. Like, none of them are like over 10x. Like, they're all like single digit. And the interesting thing is, like, some of them could have been like a lot more, way bigger.
What do you mean by that? If they just held off and didn't sell?
Yeah, or sold at different times. I mean, BeReal. Like, I invested before they launched in the US. It was think the entry price was 9.8 million. They sold so there's a time when they were about 1/3 the size of Instagram in the US.
Interesting.
And they were, you just kind of roughly comp that low end of public comps. That's worth quite a bit of money.
Totally.
Especially compared to a $9.8 million entry price. And they ended up getting acquired the summer of 2024, which is about 2 years after they launched in the US and really blew up. I think the public price that is out there is 500 million euros or something.
Wow.
And so like at the end of the day, that it was like an okay outcome.
Interesting.
But when you just like compare, you're kind of like,
interesting.
Could have been a little bit differently. It could have ended differently. And so there's obviously like a lot more you can share privately about like certain things, the way that things happened. But yeah, and I think, and the other one, like getting acquired by Amazon, they're basically like one of those like smart AI devices.
Interesting.
I don't know if people listening remember, there's like a couple of these that were like pretty hyped up of like little orange box or like a little pin that sits on your chest and like it's the next iPhone and whatever. And they basically built something that actually works and people were using it. And they just kind of saw the writing on the wall of like, we were just going to have to, if you want to be a mass scale consumer AI product, you need to raise a ton of money. Like you just have to burn a bunch of cash on distribution to get big. And Amazon was super interested in what they're doing. And Amazon has Alexa. It's actually probably one of the biggest, if you consider voice as like AI, it's like the most scaled AI, like physical hardware product. And there was just an opportunity to basically like become that next thing at Amazon. So they could have kept going. I mean, but it would have been just like, we got to do the same thing everyone else did. We're raising hundreds of millions of dollars and with no revenue because we got to like get a bunch of inventory. We've got to, and then they actually did have a lot of revenue. They had a lot of people that were buying the product, and that's kind of why Amazon was interested. But there was like a trade-off of, do we keep going or can we use Amazon's distribution? And kind of, you like lock in the gains, right?
Totally.
As an investor, there's this trade-off of like, yeah, this could, we could get like a nice early win. LPs are happy we return some capital relatively early on.
Yeah. Or
we can, like double the chips, like double down, push more onto the table, and you still could lose. So it's not always the investor that's making that decision, right? A lot of the times it's the founders. And so you just kind of have to, you can maybe influence, you can give them advice, you can kind of give them, your feedback on things. You could say, I personally, selfishly, I think you should do this, but honestly, for like your case and like the case of the business, this might be the best decision. You can also sell secondaries in some cases. I've had cases where it actually was, you had like a secondary sale lined up, and just the setup of the business and the setup of like their funding made it like you couldn't actually execute the deal, even though you had someone that was agreed to and you kind of lined it up. So that's always tricky too. I think the capital markets are just hard to predict. And so coming back to my earlier point, it's like you should really set yourself up to enjoy the upside, not get screwed if the upside isn't there. Like you want to basically have a good foundation where if it's just a bad decade or bad time in the markets, like the strategy still works and makes sense. And you just, if you get lucky in the case of like you get to exit some things in 2020 and 2021, you benefit from it, not sweating that, we need to like return capital. Like we need people to be, we need Masa to come back in order to like get a 1x. So I would just so much rather be, Masa comes back and you get a 10x fund instead of a 1x fund. I just think that's the way you're supposed to do it.
I moved to San Francisco start of the year. The change in the best possible way this year has been absolutely incredible.
Oh yeah. My biggest travel hack right now is you just stay around Union Square.
Totally.
Because people think it's a terrible area.
It's a really good point.
It's not perfect, but it is so much better. And the hotel prices are still like, the hotel I stay in, it's usually like $200 a night. And it's like a really nice hotel. So you're like, in a normal city, it would be like $600, $700, $800 a night, but it's only $200 because it's like it's like a couple blocks between Union Square and like the Tenderloin, but it's still perfectly safe, I would say.
Totally.
To stay in as a white man, like a white dude who's like 34 and like, I'm fine if like a weird person walks up to me. But I do think that's going to go away. Like I think people are starting to realize that SF is kind of getting a little bit better. It's coming back. So I'm prepared. I'm like, okay, actually saying this out loud because I know it's already going to go away. And maybe I'm make a couple more people are going to start staying in the area. But I think there's like a supply demand where just like there's a lot of hotels. It's always been kind of a tourist area and there's just not enough people are staying there. So the prices are pretty cheap right now.
Yep.
But I feel like generally in SF, that's kind of the case is like some things are still a little bit underpriced.
I hear about these like spin outs pretty common. Like a lot of the times the motion in venture, especially if you're like partner GP level right now, is like you talk to the firms and you're like, hey, like these are my 3 or 4 firms that are viable, are on my short list that I would join. Are any of them hiring right now? And I'll be, no, yes, no, no. All right, great. I'm going to spin out, right? Like I'm going to do it at the end of the year. I want to start meeting LPs, having these conversations kind of thing. So I think last weekend, one spin out made the exact comment. Couldn't find a name to the fund, right? Didn't want to use his name. Was talking with some like pretty high profile comms folks that were helping him out a little bit. So there's definitely opportunity for someone who's really good at naming venture capital firms.
I think you just have to think about what stands out. Like, I mean, the way that most people think about raising money is there's just a spreadsheet with some names and you just want to be on the spreadsheet. You want to be when a founder is going to ping their friend, 5 people, 10 people is like, hey man, I'm raising money. Like who are your favorite investors? You just want to show up on the spreadsheet.
Totally.
So I think it's usually alphabetized, honestly.
Interesting.
So you probably want to be close. I mean, A16Z is always at the top if you're alphabetizing. A lot of people will rank though. A lot of people get priorities like 1, 2, 3. A lot of people, they'll go to all the 2s first. They'll like the first week, they'll talk to their like, they're just kind of neutral on them. Like they might be nice, but like you save the ones that you really like. You probably don't want them to be your first pitch. So you might have A16 is a good example. Some people have them as like the practice pitch. Some people have them as like the holy grail. Like this is the sweating going into the meeting. It's like so I need Mark Andreessen to like bless my business and like guide me to salvation and the promised land. So like everyone thinks about these funds differently, but I think you just want to show up on the list. I mean, there's thousands of funds. Like I was doing this thing. I made this tweet once. Someone made a joke. It was like, startups as animals or something. And it was like all these different startups and like what they would be as an animal. And I kind of made it, I kind of remixed it as like venture funds as trees. And it was literally just like the names of funds that were trees. Cause it was like, there's so many options out there.
Yep.
And so I just searched up a list of venture funds. I was scrolling for like 20 minutes on this thing. Just there's thousands of names on it. And so I think that's the challenge is just like, how do people even know that you exist? Like, how do they know to talk to you? And then you might think there's tons of competition, but at the end of the day, like, yeah, everyone knows Sequoia, everyone knows Benchmark. Sequoia is not going to invest if you don't have a ton of traction or you previously, built a company that they have high respect for, whether you're a founder or a high contributor, like a significant contributor to the success of the business.
Totally.
It's just that they just have so much stuff that they're looking at. And a lot of these funds are actually growth funds. They're not early stage funds. So I think the actual universe of people who would write a check in someone who's kind of unproven in an unproven category or market or something that's not an A16Z blog post or flagship fund, right? Like if you're doing something that A16Z has never talked about before. So everyone, I mean, I think the unspoken kind of law in ventures, like you need quick markups, right? Like you give a founder money, they get marked up and you go out and raise the next fund. So people mostly are deploying capital into whatever the downstream funds are deploying into today. I mean, that's why you see these like hype cycles with like,
interesting.
That's how Web3 took over. Everyone I talked to was like, yeah, we don't really get it, doesn't make sense, but like it gets markups. Everyone knows this is, the game's ending, but like you need to get markups. You got to invest in this stuff.
Yeah.
So if it's a founder, if you're not doing that, it can be really hard to raise money. And I actually think it's pretty easy to invest in stuff that's like somewhat non-consensus that actually is probably going to work with good founders. They're just doing something that's just kind of weird that people don't get. I actually think there's a pretty short list of people that kind of do that, whether the founders know it or not, right? Like they might make their list and they talk to 50 people and like no one's interested because it's not an AI thing.
Totally.
And you can still do AI stuff. I actually think as a founder, you probably should. You should probably optimize. You don't want to underprice your equity. Like you want to make sure you get a fair price. You don't want to be too overvalued, but like you don't want to undervalue yourself. And I think there's a lot of things that's happening in AI right now is like let's say you're working at a company, you're like an AI researcher, or like you did go to market at an AI company or however it ends up being spun.
Yep.
But like, you could maybe make $1 million in comp in TC this year, like 300 salary, get some, 500 million in like options or RSUs. That's maybe kind of nice, but like you could also go and raise $10 million and have your equity be worth 25 million on paper or whatever it ends up being.
Totally.
So when you start to do that math, there's like a certain trade-off where you think about liquidity and like how real it all is and how much work you actually have to do. Whether you choose to do the work or not is like also another thing with starting a company. But you actually start to think of like, you know what, I probably should just start a company because I can make so much more money. Like it's actually economically rational for me to do this. So I think as a founder, those are kind of the things that a lot of people think about. And then as an investor, it's like up to you. Like, how do you kind of fit in the stack? What do you choose to compete on? So I just think a lot. I just have not really chosen to compete in that game. I think a lot about you got to make money at the end of the day.
Totally.
And you want to be able to say with a straight face, this is how it'll make sense and why I think that this makes sense as like a venture fund that you get traditionally the returns that you'd see in a venture fund.
Totally. You mentioned CPG. Think check size, sweet spot, 100, 250K. You like being part of the first round most of the time. What other categories right now or types of companies are you looking to write checks into?
So it's super general. I probably invest in more consumer related things than VC 101 would say. I mean, if you ask the average person, it's like consumer sucks, like just do B2B SaaS. That was like the meme for a decade.
Yep.
I think there's a lot, like all the biggest companies in the world are started as consumer companies, and they also now sell B2B. So like Apple, I think they're the most valuable company in the world. Like they make phones for, like, it's a physical hardware company.
Yep.
And it's a consumer product really at the end of the day, but they also kind of sell to businesses. Google, consumer product, also have a physical hardware component. They make data centers and cloud, and they also sell the cloud stuff to businesses, but also really at the end of the day, all the revenue is coming from businesses paying to reach consumers with ads. So, and like Instacart's one of the biggest consumer companies like of the last kind of generation. You look at something like, there's also been a lot of failures though too. Like, say like maybe Casper, all the D2C brands. I mean, there's reasons. Like, I think it's just like you didn't actually build a real business, sustainable, defensible business. So I think consumers just kind of been beaten down generally. I just think CPG is kind of interesting because everyone just thinks it's a terrible category, but there's a lot of these massive consumer publicly traded companies like Coke, Kellogg's, General Mills. I think Post is still publicly traded, Dr. Pepper, Tyson Foods. There's a lot of these like boomer run companies. It's like they do tens of billions or hundreds of billions in revenue, maybe in some like private European businesses, and just like these random esoteric categories. And they're basically run by people with trust funds. They're mostly owned by people with trust funds, owned and run by, they're owned by a bunch of, indexes and passive investors. And then like the people who are actually making decisions and like the people running the companies, they own like 0.01% of the company, right? And they maybe get like a $7 million a year salary or $2 million, they get comped and like an extra 5 or 10 million in shares if they hit quarterly earnings. And that's the reason the food system is so messed up. Just because the incentives in this entire industry is just making money. It's not actually making people healthier. And I think it's an interesting time where you look at like what Brian Johnson's done is perfect example of people actually do care about this stuff. And so I think there's an interesting opportunity right now to just, people are taking their health into their own hands. And I like investing in places that don't have good competitors, like back good founders, you know, massive outcomes, whatever, but also like bad, dumb competitors who don't know how to use the internet, who are incentivized to not change and compete against you. I think that's, if you combine that with all the other, you know, verbatim that people will say about what makes a good venture investment. So like, I wouldn't want to compete against Sam Altman and OpenAI. I wouldn't want to compete against Zuck. I don't know who the CEO of Kellogg is, actually. Like, I truly don't know.
No, it's not Kellogg.
Yeah, it's I do, like, so, and we spend trillions of dollars a year on food.
Yeah, totally. That's
maybe,
a really interesting point.
Yeah, and so I'll probably continue to make like 1 or 2 investments a year just in that category, like just food, health, nutrition, something like that. Just like, I even do some B2B SaaS investing, like AI stuff. I haven't really done a lot.
Sousa just marked up Hanover that you did in was it pre-seed or seed?
I actually don't know if it was marked up. I think they just invested a little bit more on a safe.
Cool. And that's a fund admin, similar Angels List kind of comp or.
Yeah, probably not. Yeah, I think it's pretty institutional grade. Like, cool. I mean, some of their customers have billions in AUM, and fund admin is not really something that you'd probably see A16Z blogging about how much they love the category. Right. Service driven, very like poor experience, not very automated, doesn't scale very well. It's super fragmented. If you just look at like, there's a lot of these companies that are like kind of like boutique fund admin shops that service 50 clients and they have like 20 account reps or maybe like 10 account reps, and they're doing like 100 million or 300 million in revenue, and they're starting to get rolled up by PE firms now because they're like decent kind of cash flow businesses, but like don't really scale the best because they're like a service business. That's literally the down the fairway of what kind of works in AI right now.
Interesting.
Of like, you can automate a lot of this stuff, and you just kind of look at the comp and the peer set of fund admin providers that a lot of VCs use. They are not very happy, like on the institutional side, with the options that they have. So Hanover is just like pretty quickly just flipping people when they do a new fund or when they're looking at making a decision on a new fund. I mean, even some people, not even when they're doing a new fund, they're just like, get me out of here. Like, this seems so much better. It's also selling to the CFO. So we talked earlier about Ramp is selling to like the CFO, like the enterprise CFO. No one is building products for asset management firm CFOs. And there's tens of trillions of dollars, maybe like 10 trillion in the private markets, venture, real estate, private credit, hedge funds. If you just think of broadly, like there's hundreds of trillions in just like assets of some kind around the world. Like, they need a fund admin, whether they're public, private, et cetera. The incentives right now in asset management is shifting things towards private. You think about, if you're a public asset manager, you can charge maybe 1% management fees, maybe 12% carry. Private markets, people charge 2, sometimes 2.5% management fees, and 20, sometimes 30% carry. Yeah. So the incentives are that things are going to keep shifting to the private markets. You can also insider trade in the private markets, right? Like, it's just like, oh, we got a big contract coming, like, let's just do a new round at, this seems like a fair price. And you can't do that in the public markets. It's illegal. But that is how the private markets work. Like, that's how you get alpha in the private markets in a certain way. So I think a lot of a lot of assets are going to shift towards needing that kind of service. There's a lot of other interesting stuff that, Chris and the Hanover guys can probably do that maybe they'll talk more about. I think this is all generally probably like out there in the ether. But yeah, I think we mentioned earlier, I met him and I was like, man, this guy's, even if he pivots to some weird thing that I don't think is a good idea, I want to bet on him before he has a product. And that's exactly what he did. I gave him money and then he decided fund admin is what I'm going after.
Awesome.
So it's an interesting kind of category that probably at first glance, like if somebody's like, hey, I'm investing in this fund admin, like, you want to take a look at the Series A? Oh, like, a lot of people will be like, no, thank you. But it is an AI company. Like, they automate a lot of stuff. So I think I think you can actually monetize AUM a lot more than people would think. So
that's really interesting. Okay.
And like BeReal also. I mean, BeReal is like a social media app. Like, I try to actively avoid investing in people competing against Zuck, right? Like, it's like, I'm trying to not have exposure to this category, but they just had such good data, like, and people loved the product. And it was, the interesting thing was I have some cousins in France, and I messaged them on Facebook, and they both used it. One of them had deleted Snapchat and was only using BeReal, and one of them didn't use social media but did use BeReal. So it's like, wow, that's actually a little bit insane.
That is insane
to kind of find something like that early. And yeah, so, and then a lot of the stuff that I'm investing in, there's like, you know, it's kind of something where it may not be working necessarily, or like there's not a lot of consensus around like a certain category, but it could work. And I think that's kind of the point of a lot of true venture capital, is you're kind of risk seeking, you're kind of going on this adventure of like, can we build a company around this thing? Like there's a reason that they're only raising a couple $1 million, because if they were raising 20 million, it's because it probably is a good idea and it's probably going to work. And I just like don't think that's my job as somebody that's doing like first round. I struggle with calling it pre-seed and seed, because like sometimes you'll do a pre-seed and it's 30 million post because it's like the first round or whatever. I just think about it as like, you got to get a cost basis on your fund around like between 10 and 20, probably like 15 million post. If you start creeping too high above that, I kind of think about it more as like a Series A-ish type fund, like a second or third round type of fund. I kind of like think of myself more as like a first or second round type fund. So
interesting. And there's a clear line for sure. There's a distinction.
Like I think if you probably about like half the things I invest in, there's like no product yet, or like there's no revenue yet, and there'll be some where like there's a little bit, or maybe like occasionally there's actually kind of a lot. But generally, I think if you're doing venture capital, kind of as like we think of it as more of like the traditional sense, you kind of have to be taking a lot of risk around. Will there be adoption? Will customers use the market even there? Are the founders good? Like, can they actually do this? I think you have to be taking a lot of risks. And I think a lot of people like to mitigate as many risks as they can, and think that they're doing it, but maybe not actually doing it. Yeah. Or hyper mitigating for just one risk of like, this is definitely a thing, but like everything else is still super risky, and you actually added more risk because you mitigated that risk so much that you actually increased the risk of something, because there's like the risk of making money, right? Totally. It's like there's literally no way that you're actually gonna make money on this. I don't know. I think it's like a just interesting frameworks for thinking through this stuff.
I love your approach. From a founder or an LP who backs emerging managers, you're deploying out of your third fund right now or kicking off 3. What's the best way to get a hold of you or reach out?
I'm pretty public online. I think if you go to my Twitter, my DMs are open. I think my emails on my LinkedIn, turner@bananacapital.vc. Those are probably some of the best ways. Yeah. Awesome.
I pinged you on X. You got back to me, so I know that's a real thing.
Yeah. I try to see it. I mean, I think if you just send someone a good cold email, if there's like a reason to respond, people will respond. You know what I mean?
Yep. The good word in that sentence is important.
Yeah, I mean, I think like someone would just say like hi, right? It's like what am I going to do with that, right? Like that's like kind of like some people kind of do that. But I think if you just like think of something well thought out, like why should we meet? Why should we talk? Like what's the reason? And if it's a good reason, most people will at least give you the time. So
I think that's good advice. Awesome. Well, thank you for being my first guest and what is now On the Rise. We'll see if it launches as On the Rise.
Yeah, I think this is a lot of fun.
Awesome. Thank you, Turner.
Thank you.